Over the last few weeks, I've seen three headlines over and over again. Mortgage arrears are rising. Toronto homeowners missing payments have quadrupled. Power of sale listings are increasing across Ontario. And then the big one, which is millions of mortgages are renewing at higher rates this year. So naturally, I'm hearing a lot of people ask, are we headed towards a mortgage crisis? Or is this just an uncomfortable part of higher interest rates? So let's walk through this properly. Do me a favor. If you like real estate mortgages and care about Canadian macroeconomic data, do me a favor and subscribe. Okay, so here it is. If you're on the podcast, I'm going to try and best verbally break this down for you. So we have a graph on Yahoo Finance here that essentially looks like a steep incline in mortgage delinquency rate. This is coming from CMHC and Equifax Canada. This one in particular is actually quite misleading, as if you look on the left column here, we have it going by a fifth to a 20th of a percentage. So we have the start of Q1 2020 all the way up to currently now Q1 of 2026. So you can see that mortgage delinquency rates have risen to over a 20th of a percentage. And so if I pull over here to another article, and this is again, the left axis here is going by basically essentially a 10th of a percentage to a 30th of a percentage. Interestingly enough, looking back at our other article, it seems like mortgage delinquencies have risen quite substantially since 2020. But if you look past 2020, where they conveniently cut off the graph, we've actually become on par with, if I scroll back here, currently we have the mortgage delinquencies, which are at 24th of a percent. And this is up from a low in July of 2022, which was a 14th of a percent. So a 14th of a percent of all Canadian mortgages at big Canadian banks have gone to arrears. And so that's why when they say quadrupled, it's quadrupled, but it's still quadrupled from a very small number, and it still is a very small number. So if we go back here on our chart, our current mortgage arrear level at Canadian banks, which is at about a 25th of a percent, just under, is around on par with September of 2020. But even going back, it's still lower than we saw a peak in June of 2020 and previously in September of 2016. So this is nowhere near what we previously saw with, as an example, an '08 financial crisis, right? Where even Canadian, because of our stricter lending laws, were quite sheltered from what the States saw, but it's still nowhere near previous highs that we have seen. So a lot of people are talking about this mortgage renewal wave like it's some doomsday event coming next year. Sorry if you're on the podcast and the doomsday was super loud. It might have sounded terrible. But anyways, here's the thing though, is it's already happening. And as a mortgage agent, the last year, I've seen it happening firsthand with clients coming into my world. It's just the nature of the interest rate market, right? Sometimes these things happen in cycles. I've seen clients that are coming up for expiry on their 5-year rates from 2020, where they were at, let's say a percentage and an eighth, and now they're renewing at, an over a 4% interest rate. And so this is not unusual, right? This is another million coming up through to 2027. And so this isn't just a forecast. This is reality. It's happening literally right now. So for context, CMHC mentioned this article as discussed. 1.5 million households have already renewed their mortgages at higher interest rates, and another million are set to renew their terms for the upcoming year. So this has resulted in people's ability to save, squeeze discretionary spending, and influence both new and existing credits. That being said, CMHC did highlight in this same article that mortgage arrears, while rising, are still below historical levels, which you are going to dive into a bit deeper on a bit further. So no, it's not a '08 crisis, but interestingly enough, they have mentioned that they believe the number of high-risk borrowers and the debt they have hold has grown since 2021. One really interesting key point from this article, again, if you're on the podcast, I'm going to try and do the best to break this down. One of the headlines they mention here is homeowners have prioritized short-term affordability over long-term debt exposure. So we're going to get to that in a minute, but essentially what that means is actually restructuring the terms of their mortgage, terms of the loan to get lower payments by extending out the length of their term, refinancing to extend their amortization, which we'll get into shortly. Okay, so here's the really interesting part. If we hear about these millions of people renewing higher, why haven't mortgage arrears exploded? Three reasons. And I recall inspiration for this segment of our video is brought to you by my good buddy Lucas. Lucas, if you're listening to this, shout out to you. The first reason is the stress test. So in Canada, in order to qualify for a mortgage, you have to go through what is called the stress test. Now, the stress test mandates that a borrowee is tested, stressed, at a rate of either their contract rate plus two. So let's say you're renewing right now at a 4% rate, your stress tested rate would be 6%, or 5.25%, whatever is the higher. So for those people in 2020, say, who are getting rates of 2% or lower, they still would have been stress tested at a 5.25% interest rate. So this goes a long way in ensuring, Canada, we have variable debt, so to speak. Our debt becomes up for expiry. We renegotiate it every couple of years. This goes a long way in ensuring long-term health and longevity for our borrowers. So that's reason number one. Reason number two is employment. So people lose homes when they lose jobs, not just when rates rise. So that's reason number two. And reason number three is that people are adjusting. Again, I see this all the time as a mortgage agent, is that, just because your interest rate is increasing and you're coming up for renewal doesn't necessarily mean you're out of options, especially when you go to someone like myself, right? People are, say, extending their amortizations, right? Increasing the length of their loan out from, say, 20 years back to 30 years or to 25 years, right? Extending amortizations, cutting spending, right? Refinancing could be the term that you could use for extending amortizations, is the technical term for it. Essentially moving debt around, right? So that doesn't mean things that, doesn't mean that things are feeling good for those borrowers because they're still technically taking on more debt, but they get to stay in their homes and have a lower monthly payment, right? So it helps people absorb that hit. I thought this article put out by CMHC, this is the Canadian Mortgage and Housing Corporation, was really interesting because it highlighted how, and this might be in line with why we've seen these articles, which might be taking this as a out of proportion, is it that the Toronto and Vancouver have essentially been a microcosm of these mortgage arrears, where as opposed to other markets, we've seen the steepest incline in these major metropolitan areas. And so I thought this quote was interesting that they pulled, is that on one hand, there are clear signs of household strain in regions like Toronto and Vancouver, where arrears are projected to continue to increase steadily. Additionally, certain groups of borrowers across the country are showing more vulnerability than others. For these groups, especially the pandemic era first-time homebuyers, that financial pressure is much more evident. Okay, so let's talk now about the microcosm of Toronto and Vancouver. Why are they feeling this more? Right? Because we keep seeing Toronto, Vancouver showing up in these reports. So here's why. It's essentially pretty simple. Higher prices, larger mortgages means thinner margin. When your mortgage is $900,000 instead of $400K, the spread on that rate change and how that monthly payment affects your mortgage is, that rate change hurts a lot more. It's much more significant. I think people underestimate or overestimate really a rate change on a $400,000 mortgage, and perhaps might be underestimating the spread of what that monthly payment looks like on the difference in those two mortgages. So this is where I think, my personal opinion, where I believe the real risk is. Looking past the headlines, this is where I see the pressure. So yes, absolutely, you have recent buyers from 2020 to 2022. I actually think that it's less about buyers who say are we're banking on interest rates to stay low and more about buyers who are counting on appreciation or a quick flip to bail them out should rates rise. So we're seeing a lot of highly leveraged investors who we've seen house prices fall across not just Toronto and Vancouver, but most of Ontario and British Columbia. So we're seeing a lot of negative equity on properties where now in some extreme examples, the mortgage amount is actually higher than what the property is actually worth itself right now. So for some of these homeowners, investors, a refinance is actually impossible because no lender, not even a private lender, where you'll see interest rates of staggering numbers and all kinds of fees and terms, insane terms. Not even those lenders will lend on these properties because no one is going to lend on a property where there's negative equity because the value in that property doesn't exist. Think about it from your standpoint, right? If you're giving someone money on, I don't know, we can use a car or something, right? If someone asks you to lend them $20,000 on a car that's worth 10 grand and they can't make their mortgage payment, then you're in the whole 10 grand on your collateral. So you're going to take that deal? Absolutely not. And no bank is going to either. They're not going to let you refi and lower your payments if what you're asking for is worth less than what the property actually is. So that is the real issue with where people are feeling the real pinch on these increasing interest rates, and the um, the property market is that extreme example where people are solely counting on the fast appreciation of real estate to cover the cost of those higher interest rates. So what would we actually need to see for this to become some kind of doomsday event? Again, this is kind of crystal ball question. It's like when people ask me, Jonah, what's going to happen with interest rates? I'm like, I have no idea, right? Like that goes with the socioeconomic status of our country and what happens to neighbors down the south. This is a little crystal ball ask, but essentially, I put together a couple points here. What would we actually need to see for this to get bad? A real substantial rise in unemployment. Canada has lost some jobs with the recent, call it a trade war if you want, or not, negotiations with our neighbors to the south. But our unemployment rate actually has stayed relatively on par. The only other thing that could accelerate this is a forced sales accelerating meaningfully, because then a lot of banks will be losing money on the assets and property prices would stagger even more, much like we saw in 2008, where we saw all these forced sales, which was driving down the value of the market. And that's why we saw a lot of lenders go under. And as I had mentioned before, the only other point that I have here is that a lot of people losing equity, which we have seen in very niche examples, but nothing substantial that could actually change the tone of the market. So overall, what's happening right now is uncomfortable because, we are seeing it firsthand. Rates are going up fast, payments are higher, and some households are feeling stretched. But at the end of the day, stretched isn't the same word as collapsing that you're seeing in the headlines. And stress doesn't automatically mean crisis. And so, yes, missed payments are rising, and yes, arrears are trending upwards nationally. But so far, what we're seeing is pressure and not this overall breakdown that CP24 or the Toronto Star wants to make it out to be. So yeah, if you have any questions or want to know what this looks like for your specific city or segment as an investor, first time buyer, renewals, feel free to comment below and we can start a chat. The content of this show is for educational and informational purposes only. It is not intended as financial, legal, or investment advice. Always consult a qualified professional for advice tailored to your unique circumstances. The views expressed are that of the host and guests and do not necessarily reflect the opinions of affiliated organizations. Jonah Hoyas is a mortgage agent with Tango Financial Ontario, license number 13691, agent license M2500789.